Today, we're breaking down XLE, the Energy Select Sector SPDR fund, one of the most widely traded and recognizable energy ETFs in the market. If you want simple, liquid exposure to the biggest oil and gas companies in the United States, XLE is often the first ETF investors look at. XLE tracks a market cap-weighted index of energy companies from the S&P 500, meaning it holds large U.S. energy firms that fall under the Global Industry Classification Standard, or GICs. This includes companies involved in oil, gas, consumable fuels, and energy equipment and services. Because XLE pulls its holdings directly from the S&P 500, the portfolio is heavily tilted toward large-cap energy giants rather than smaller exploration companies or midstream pipeline operators. That means when investors buy XLE, they're essentially getting concentrated exposure to the biggest players in the U.S. energy sector. Names like ExxonMobil and Chevron typically dominate the fund and can make up a significant portion of the portfolio. To prevent a single company from becoming too dominant, the index uses a capping methodology that limits any one security to 25% of the portfolio at each quarterly rebalance. Even with that cap, the fund remains fairly concentrated compared to broader sector ETFs. One of the biggest advantages of XLE is liquidity. It's one of the most actively traded sector ETFs in the world, with tight bid-ask spreads and deep options markets. That makes it popular not only with long-term investors, but also with traders looking to express a view on oil prices or the broader energy sector. Another key feature is that XLE provides equity exposure to energy companies rather than direct exposure to oil prices. In other words, the ETF's performance is influenced by oil and gas prices, but it also depends on company profitability, capital discipline, dividends, and broader stock market conditions. For investors building diversified portfolios, XLE can serve as a sector allocation tool or as a macro trade during periods of rising energy demand, inflation, or geopolitical tension when energy stocks historically tend to outperform. It's also worth noting that prior to December 1st, 2025, the fund name did not include the issuer's name, State Street, though the underlying strategy and index remained the same. Overall, XLE remains one of the simplest and most efficient ways to gain exposure to the U.S. energy sector, offering a liquid basket of the largest energy companies in the S&P 500 in a single trade. If you found this breakdown helpful, make sure to like, subscribe, and follow the channel for more ETF deep dives. And let me know in the comments which ETF you want me to cover next.